Did you know that you can legally write off a portion of your rental property's value every single year, even if the property is going up in value? That's the power of depreciation, and if you own a rental property or you plan on owning a rental property, this is something you cannot afford to miss. Hi, my name is Grace. I'm a real estate accountant and I run Brick and Ledger. We help property owners and real estate investors keep more of what they earn. Today, I'm going to walk you through residential depreciation from start to finish, what it is, how to calculate it, the tax benefits, and the common mistakes I see all the time. I'm also going to include some advanced strategies near the end that can save you thousands of dollars throughout your investing career. But let's start simple. So depreciation is just the IRS's way of acknowledging that things wear out over time. Your rental property is an asset, and the IRS says you can deduct a portion of that asset because theoretically it should be losing value due to weathering and aging, even though in reality your property is probably going up in value. But for tax purposes, it's slowly wearing out. For residential rental properties, this includes single-family homes, duplexes, small apartment buildings. The IRS uses a very specific schedule, 27 and a half years. That means you take the value of the building, not the land because the land doesn't wear out, but you take the value of the building and you divide it by 27.5. The number you get, that's your yearly depreciation deduction. You get that every single year for the next 27 and a half years that you own the property as long as it's serving as a rental. Let's go through a real example. So let's say you bought a property for $350,000. You look at your tax statement or you get an appraisal and the land is worth $75,000 and the building is worth $275,000. We're only going to be looking at that $275,000. $275,000 divided by 27.5, just to keep it easy and simple, that's $10,000 in depreciation per year. So every year you get to reduce your taxable rental income by $10,000. So if you're in the 24% federal tax bracket, that's a tax savings of $2,400. And that's before we even talk about state taxes. And the best part is that depreciation is a non-cash expense. This is a paper loss, so you don't actually have to give anyone $10,000. You get to keep that in your pocket. Okay, now let's see how this would play out on your tax return. So let's imagine your rental property makes $24,000 a year, but your normal expenses like insurance, taxes, maintenance, that comes out to $8,000. So without depreciation, your taxable rental income is $16,000. But apply that $10,000 in depreciation, your taxable rental income drops to $6,000. If you're in the 24% tax bracket, that's another $2,400 off your bill. Over 10 years, that's $24,000 in tax savings alone, just on one property from depreciation. When you start stacking multiple properties, this obviously becomes a major tax advantage. I have clients that reduce their taxable income to zero just from depreciation. Meanwhile, they're cash flowing thousands of dollars every month. Depreciation is a gift. But here's the thing, people mess this up all of the time, so let's talk about it. Mistake number one, forgetting to take depreciation. The IRS actually requires you to take depreciation, and so if you're not taking it, you're missing out on the benefit, but they'll still tax you like you took it later. Mistake number two, depreciating the land too. Remember, land does not wear out, so you cannot depreciate it. Mistake number three, using the wrong basis. So your basis isn't always just your purchase price. It can include certain closing costs and other improvements that you made before putting the property into service. Mistake number four, not adjusting for improvements. Let's say you get a new roof, that's a depreciable improvement. Same if you remodel a kitchen, those have their own schedules. Keep these four mistakes in mind while you're thinking about how you can use depreciation. Now let's get into the fun stuff, how to maximize depreciation. One advanced move is called cost segregation. Instead of depreciating the entire building over 27.5 years, you break out certain components. This includes appliances, flooring, countertops. You break those out and you depreciate them over 5, 7, or 15 years. Breaking these out can create huge paper losses that completely wipe out your rental income on paper, even though you're still making money. And with the new changes in bonus depreciation, you can even deduct some of the full cost of these items in the first year. That's a lot of depreciation. Here's a tip: time your improvements. If you know you'll have high income in a certain year, it can totally make sense to complete and place improvements into service in that year so you can have higher depreciation. Okay, now we have to talk about the part that nobody likes: depreciation recapture. When you sell your rental, the IRS will recapture the depreciation you've taken, and this is taxed up to 25%. So if you've taken $100,000 in depreciation over the years, the IRS will want taxes on that portion of the gain when you sell. The good news: you can defer this through a 1031 exchange and roll it into another property. Or you can hold this until your death, and then the recapture just gets wiped out. It doesn't transfer to your heirs or anything. Okay, I know that was short and we just skimmed the surface level. We still have so much more to cover, so please subscribe. Remember, depreciation is one of the biggest benefits of owning real estate, but the IRS does not go easy on mistakes. Don't leave money on the table. If you own a rental property, this is definitely a tax strategy you want in your toolkit. And of course, if you want any help, contact Brick and Ledger. That is what we're here for. We want you to get every single dollar that you're entitled to. I'll drop all the contact details and the website in the description below, but thank you so much for watching. I hope you learned something, and I will see you in the next one.